You may have wondered, as many do, if there's a way to predict the stock market. Actually, a lot of people think that it is predictable. When we were talking about the stock market crash in 1929, just before the Great Depression, you may have wondered how people didn't see it coming. But since we've been talking about rational expectations, I want to quote our old friend Deirdre McCloskey, who had this to say. Muth's notion was that the professors, even if correct in their model of man, could do no better in predicting than could the hog farmer, or steelmaker, or insurance company. The notion is one of intellectual modesty. The common sense is rationality. Therefore, Muth called the argument rational expectations. McCloskey is right in saying that to assume that people are rational is an act of modesty. And here, modesty goes a long way. There are thousands of people who professionally analyze data to try to predict the movements of the stock market. And so, right off the bat, we shouldn't assume that we would be any better at it than they would. But the question is, are the professionals even better than a regular person? First, we need to understand price movements. We tend to think of changes happening along a continuous line. If a stock is currently priced at $100 per share, and then information comes out that convinces everyone that the stock is worth double that value, then people will rush in to buy the stock and they'll slowly push up the price to $200. Those who act fast might be able to get in early and make a healthy profit, buying close to $100 and seeing the value rise right afterwards. But this is not how it actually happens. Every purchase of stock is also a sale. There's someone who's agreeing to part with their shares for the amount that you are paying. With this news that the company is worth double publicly available, who would be willing to sell their shares for less than $200? Everyone holding the stock will immediately update their valuation, and they won't part with it for anything less. So the price doesn't slowly rise to $200, it jumps instantly to $200. Now, if your mind is deep in this course, this should remind you of something. The instant jump in the price is a rapid adjustment. The slow climb in the price over time, well after the news is available, shows stickiness. Central to our understanding of the macroeconomy since Keynes and up to this point is that prices and wages are sticky. But to believe that is to believe that the world is full of people who would sell their stock worth $200 for something way less. Financial economists observing how prices change in financial markets develop the efficient market hypothesis. It says that stock prices should reflect all available information. That means whether or not a stock price goes up or down in the future depends entirely on information no one has. That means it is impossible to predict how stock prices will change, and any guess will be as good as random chance. Think about it this way. Suppose you had an old baseball card you never really thought twice about until a friend spotted it and said they would give you $500 for it. You didn't think the card was worth anything before, so shouldn't you gladly sell it? Well, probably you would want to know why your friend is willing to give you so much money for it. Is it actually worth thousands of dollars and your friend is ripping you off? In that scenario, the price offered is acting like a signal of the information your friend has. Of course, we already know this. Prices are a signal wrapped up in an incentive, as Professor Tabarrok told us many chapters ago. The same is true with financial markets. As soon as someone has information about the future value of a stock, they have a huge financial incentive to take action on that. And the action they take will serve as a signal to the rest of the market that will rapidly adjust the price to fully incorporate that information. For this reason, economists and financial experts say that changes in the prices of financial assets are a random walk. There is just no way to consistently beat the market because no person will be able to stay ahead of prices rapidly incorporating information. Essentially, the efficient market hypothesis predicts that even the smartest experts will do no better at trading stocks than a monkey throwing darts at the stock page of a newspaper. So, do you buy it? Do you believe a monkey would do as well as a seasoned Wall Street analyst? Let's find out.
My darts landed on 30 companies. How would they do compared to the stocks recommended by managed mutual funds? Oops, better. From the start of the year till now, the stock prices of the companies hit by my darts increased by 31%. The 10 biggest managed funds rose only 9.5%.
Okay, I admit I got lucky. Had I thrown the darts a million times to get to an average throw, my dart portfolio would have increased 12% this year. That's how much the average stock on that table has gone up. But that still beat the professionally managed funds. How can that be? And how can it be that study after study shows that picking stocks randomly or buying what's known as an index fund, a fund that owns a little bit of every stock, has brought higher returns than putting money in managed funds?
In microeconomics, people are assumed to be rational. Like Deirdre McCloskey said, this assumption is an act of humility, and it's one of the things I love most about economics. We don't look down on regular people, we look up to them. We assume that people maximize their utility, another word for their well-being, subject to their budget constraint or the limits of their economic conditions. In other words, people do the best that they can. Finding the implications that these assumptions have for how our economy will make use of the resources and technology we have in order to satisfy human needs and wants was the great project of the classical economists. And it gets pretty far in understanding our actual world. In reality, humans are not perfectly rational, but their economic behavior comes pretty close to what an assumption of rationality suggests. But after Keynes, this assumption of rationality was thrown out of macroeconomics, and the next generation of economists came up learning about two contradictory views on how the economy functioned. Some wanted to bridge that divide, but others wondered if it was possible to throw out the Keynesian-inspired macroeconomics altogether and form a theory of the business cycle rooted in concepts like rational expectations and the efficient market hypothesis.